By this point, you should have learned about corporation characteristics and common shares. In this video, we're going to look at preferred shares. Primarily, we're going to be looking at the characteristics more so than the actual bookkeeping. So let's do a quick review. I'd encourage you to pause the video at this point and answer these questions as best you can. First question: what are the two classes of shares? Well, we should have already learned that from the previous slide. First one is common shares and preferred shares. What are three rights common shareholders have? Well, they've got the right to vote, they have the right to a dividend, and they've got the right of proceeds to liquidation. And we're going to see that there's some stipulation around this and whether or not this may or may not happen depending upon what happens and how much money is actually paid out. Who gets paid first when a company is liquidated? There's actually a pretty good hierarchy of who gets paid first. Creditors, then bondholders, then preferred shareholders, then common shareholders. So actually common shareholders at the bottom of the pile. Creditors could be people like banks, institutions like banks. Bondholders are people who have lent money and usually tied to a specific asset, or could just be a financial instrument not tied to anything at all. If a corporation issued 1,000 shares at $30 per share, 2,000 shares at $32 per share, and 1,000 shares at $35 per share, and then bought 500 shares back at the market value of $34 per share, how is the gain or loss recorded? Market price of the shares minus the average cost of the shares. And of course, depending upon what they count as, it's going to be either retained earnings or contribution to capital. So let's dive in and take a look at the differences. Preferred shares. These are shares that have preferences or priority over common shares in certain areas. They receive dividends first, and in liquidation, they will be paid first before common shareholders. They usually do not have voting rights, so there are some pretty big differences between them. Here are some other features that preferred shares can have. Preferred shares can have a cumulative dividend feature. This means that shareholders must be paid dividends from the current year as well as unpaid dividends from prior years. They also have, sometimes, the ability to convert preferred shares. It gives the shareholders the option to convert preferred shares to common shares at a specific ratio. Market value is irrelevant when converting. They also can have other features like this redeemable preferred shares, which gives the corporation the right to purchase shares from the shareholders at a specific future date and a price, or convert them to common shares. And finally, retractable preferred shares. It gives the shareholders the option to redeem at an arranged price and a date. These redeemable and retractable preferred shares usually are recorded in the liability section, as the features more closely represent a liability than owner's equity. At least in this course, you've been introduced to some of the features, but you're not going to be focused on all of them. Let's take a look at some of them. The cumulative dividend. Dividend in arrears means that the dividend was not paid in the current period. This is not an account, but included in the notes of financial statements. Why might a company not be able to pay its dividend? Well, let's just think about how a company makes money. They either provide a good or a service, and they make profit. What do we do with the profit? A corporation has two options. One, to retain the profit, or two, to pay it out as a dividend. So what happens if business is bad? For example, at the current case of Air Canada or any kind of airline industry and airline company, they probably end up experiencing a loss in this quarter, possibly even for the next several quarters. They just don't have the money, so they're not able to pay dividends. They didn't have enough income at the time. Is there a consequence to not paying the dividends? Of course. Perhaps there could be some investors that are expecting to get that payment out. Investors may be upset and will not want to invest in the company. And that's understandable. Dividend in arrears example. 10,000 preferred shares had a cumulative feature that were to be paid $3 per share. Unfortunately, the company was unable to pay the dividend for the past 2 years. Calculate the dividend arrears and journalize. Well, this here, we can calculate easily, is 10,000 shares times $3, and there's 2 years worth, so it's $60,000. Remember from the last slide that there is no journal transaction required. So the only thing that is recorded is a note in the financial statements. They eventually will have to pay it though. Preferred shares example. So here's an example where we've got 100,000 preferred shares and 1,000,000 common shares. The value for the preferred shares, and yes, there are differences in values and average share prices depending upon the type of share. The value of the preferred shares is 2.315 million, and the common shares are worth 15,640,000. Preferred shares have a convertible option into 1.5 common shares. On December 31st, 5,000 preferred convertible shares are issued for $25 per share. On December 5th, 3,000 preferred shares are converted into common shares. The market value of the common shares is $20. Journalize these transactions. Actually, they're not transactions, they're just conversions. So I'd encourage you to pause at this point and try and complete these on your own. What do you think is going to happen? Well, the first transaction, December 1st, 5,000 preferred shares, convertible shares are issued for $25 per share. This means that we're going to receive cash. How much? 25 times 5,000. And what are we crediting? We're going to be crediting the preferred shares account. Bank preferred shares, 125,000. What do we do for the second one? And where did these values come from up here? Well, since more preferred shares were issued, the total value is no longer 2.315 million. Instead, we have to add them up. So this is 2,315,000 plus the new value of the preferred shares, which is 125,000. How many shares have we issued that are preferred shares? We had 100,000 from before, and we just issued 5,000. This works out to an average share price of $23.24. We're going to be using this in the next transaction. If you thought that there was something that had to do with the market value of the common shares, unfortunately, there's nothing. It's just to throw you off and check to see if you know what's going on. Let's take a look to see what does happen. We're converting 3,000 preferred shares. What's the average cost? We calculated up here, $23.24. That works out to $69,720. And we're converting them into common shares. There's no bank account that's going to be used. We're not gaining anything. We're not losing anything. There's no retained earnings or contribution to capital accounts. Just a straight change in equity. So preferred shares credited, common shares debited. And we record a note to convert to shares. That's it for this lesson. I hope you've enjoyed, and if you have any questions, send me an email or throw a question up into the Google Classroom. Bye for now.